This program was brought to you by Organo Gold. Organo Gold is a health and wellness company that provides healthy coffees, teas, and chocolate. All one has to do is consume the available coffee, teas, chocolate, and other products to get all the available benefits. One can also share these products with others to help them improve their health as well.
And now, Fairfax Breakfast Club with your host, Besile Lemba.
Welcome to the Fairfax Breakfast Club show. My name is Besile Lemba and I will be your host. The Fairfax Breakfast Club is a weekly program in which we bring to you valuable and workable know-how you can use to improve your networking skills and grow your business. Today, we are going to talk about taxes. Let's start with a rather famous quote from Benjamin Franklin. In this world, nothing can be said to be certain except death and taxes. Today's guest is a CPA, somebody who has been campaigning into lowering taxes. His name is Gerald Geddes. Hello, Gerald.
Hello, Besile.
How are you?
Thank you for having me on. I'm doing great.
My pleasure.
Good to be here.
Yeah. I know the subject of taxes is really charged up. For whatever reason, rightly or wrongly. But I know you have been talking about campaigning about lowering taxes.
Yes.
So that's what we'd like to have you talk about today. How would you go about it, or what is your plan, what is your approach?
Well, I had a situation where I was in the hospital for a while and I was recovering from an illness, and it gave me time to think about some of the issues that we have that I think are wrong. We've got some bad policies that put in a lot of disincentives for doing the right thing. Mm-hmm. And so I started my career when Ronald Reagan was president, and prior to that we had very high individual taxes. We had 70% rate. And prior to JFK being president, the top rate, I believe, was 90%. Wow. And he advocated for lowering the top individual rate and lowering corporate taxes. Unfortunately, JFK got shot before that happened, but his initiative did get voted on after he died. And it really, for the next 3 years, it grew the economy by, I think every year was at least 6.2%.
Oh, wow.
And then, you know, as things happen, the way our government works, people lobby their Congress for ideas that they have on taxes that benefit them, corporations. And so it got out of whack. And then Ronald Reagan came in, and it was a terrible economic time that Ronald Reagan had. You know, the interest rates, we had terrible inflation. For 2 years in a row, we had over 10% inflation. And we had very high interest rates. At one point, the prime rate got over 20.5%. Wow. So things were really out of whack. And he made changes to the tax law that really put our economy and the world's economy back on track again.
What was the change?
Well, one of the first things he did is he lowered the top tax rate, which had been at 70%. The first thing he did is lowered it to 50%. Real estate, you know, you can imagine, I actually bought a house in 1981, right out of college. I had an 18% mortgage on the house. Wow. You know, now we have 3% mortgages. I bought a house with an 18%. And one of the reasons I did that was one of the tax laws that he put into place. It used to be that we would depreciate rental properties over 35, 40 years. He lowered the depreciation on rental properties to 15 years. All commercial property, residential rental property was 15 years, which is kind of a huge change, but when you have an 18% mortgage, you needed a big change. And so that really helped. So a lot of people became rental property owners then, and so that grew the employment quite a bit. And then when interest rates started coming down...
Hold on one second,
Sure.
I want to stop you on that. What is the connection between bringing it to 15 years and growing the employment?
Well, it got a lot of interest in people owning rental properties, so it helped with real estate.
Gotcha. Okay, that makes sense. I'm just trying to mention that to make it clear. Okay.
One thing about like rental properties is they are a good long-term investment, and like the term pension actually has its roots in the German language, and a pension in Germany is a second home that you rent out.
Oh, really?
Yeah. I'm not exactly sure how that etymology worked, but a lot of people in Germany, their concept was that they would start saving, and then when they wanted to retire and stop working, they would buy another house that was near their house and rent that out, and that would, be their retirement income for when they could no longer work. So, but we, our tax law in 1986, Reagan put in to get rid of a lot of the deductions. We used to have all kinds of personal interest that could be deducted. He got rid of that, and we put in a lower rate. The rate actually got down to a top rate of as low as 28%. Although most people's, there was a 33% bubble to take into the difference of the exemptions, standard deductions, and the 15% rate. So there was a bubble to get to a pure 28% rate, and then over a certain level, it was 28. But that really, the initiatives that he put in really grew the economy. We had a terrible economic. There was oil strikes that caused inflation to go up. We had an oil crisis. I remember sitting in lines. We had something in the late 70s where we could only get gas like every other day. So if your license plate ended in an odd number, you can get it on one day, an even number you can get on another day. Certain letters, there was different things. So it was a terrible economic time. And there was a double dip recession that didn't end until December of '82. Unemployment got as high as 10.8%. And then at the end of Reagan's 8 years, it got down to 5.2%. 1 month, September of 1983, there were 1,114,000 jobs created in 1 month. And a lot of people are rooting this economy, this recovery on when we get over 200,000. Almost every month in the Reagan recovery was up above 200,000. I mean, it was a tremendous amount of job growth. And we only had 70 million less people in the United States back then. So it was a tremendous recovery. So I was thinking about, when I had time to recover from this illness, I was thinking about some of the policies that Reagan had. And of course, the times are different today than they were then. We don't have 18% interest rate. Now we've got pretty much the opposite problem. We have, on the 10-year treasury is like 2% or less. So we actually have something of an opposite problem. But one thing that we have that's a systemic problem is for our corporate multinationals. Our multinationals, in theory, have to pay U.S. corporate tax at the highest rate. We have the highest corporate tax rate in the world, 35%. But there's also a provision that if they keep the capital, if they keep the money offshore, they can defer it. And it used to be like companies like Apple used to book a liability for income taxes, that 35% tax. Now they might pay in Canada. Canada's corporate tax rate is 15%. So let's say if you had a business that was doing operations in the U.S. and just Canada, so they would pay 15%. If they brought the money back to the U.S., they would pay 20% on top of that. Well, the multinationals aren't bringing the money back. I mean, the zero is way better than 35%. So my thought was that if we could put in incentives for these multinationals to bring money back, because bringing that money back from these foreign banks would bring capital back, and capital makes investment corporations. They want to increase the profits for their shareholders, so they would build more manufacturing plants. They would do things to use that money to make additional profit. So we could do things to align the businesses to give them an incentive to bring money back into the United States. We have the highest corporate tax rate in the world, so we could, let's say, move it to 25% instead of 35%, and give them an incentive that it would go lower still if they helped with some of the things that the United States needs. Right now, our labor force participation rate in this recovery, it's gotten worse. We have more people.
What is labor force?
Labor force participation it's the amount of people that are of the working age and how many of them are actually working. We have more people that have gone on disability, long-term unemployment benefits, and just stopped working. Maybe they're in the underground economy, not reporting their income, but for whatever reason, they're not working, they're not getting a W-2, they're not helping to pay the taxes that need to be paid to fund the normal functions of government. So we could lower the corporate tax rate and then tell the corporations that it would be lower still if they helped to increase the labor participation. And they could do that by bringing...
How can they help to increase labor participation?
They could bring jobs back. Right now...
Oh, okay, so lower the tax, and then if they create some more jobs, they get some more reduction on the taxes.
Get a further reduction.
Okay.
The fear is that if you lower tax rates, that you'll get less money. Well, right now...
Who gets less money?
The government. The government.
Okay.
The Democrats always want to grow the size of government. They're trying to increase their voter base, keep their political power by giving benefits to their constituents. But their fear is that if they lower rates, that they won't get as much money. There won't be as much tax money. But it's kind of like the analogy of if you lower the price of tuna fish, you may sell so much tuna fish that you can actually make more profit. Raising the price of things doesn't necessarily give you more net income.
So that's the crux of it, of the paying less taxes. Meaning lower the taxes so that people can bring their business in here.
Right.
And then say you can make them lower if they create some more jobs.
Right. And you could even, the Democrats fear that if you lowered the rate that you would collect less taxes. Well, the multinationals could decide to bring money in. I mean, they could determine the amount of tax that they paid. So you could make the provision that in order to get the corporate tax rate even further lower, that one thing is that we couldn't collect less in corporate taxes than we have previously. So that could be the first criteria is, we're giving you a lower rate, but if we collect less in corporate taxes, it's going to go back up. That would give them the incentive to bring money back into the United States at a lower rate than 35. Well, but these multinationals, they also make money in the United States. So they're paying taxes at that top rate for 35%. So that incentive would line up well. They would still profit from it. So I would argue that you could lower the corporate tax rate. Still, the United States government could collect more corporate taxes. And you could lower the rate further, and they could still collect more corporate taxes until there was an equilibrium where the rate is equal to what the rate is in Europe. It would come to a natural equilibrium. At some point, you wouldn't collect as much tax money as you did the year before, and then that would be where that rate would end. But we don't do enough experimenting with taxes. We don't give things like that a try. There's not much, and so there's really a dearth of ideas that are out there. The Republicans, I mean, they definitely don't want to raise taxes because they see the whole problem with government as a spending problem, that we're spending too much. So it's not really a revenue side thing. The federal government is doing things that it shouldn't be doing. But we just have a lot of disincentives, and we could line up another thing, and you could do that. The results, you could make other criteria. It doesn't have to be labor force participation. Another criteria could be black minority unemployment. If you could get the MBA whizzes at the Fortune 500 companies, you could get their brains thinking about how to get more of the black. I think the black youth unemployment rate is like 25%. It's terrible. You could get them thinking on how to solve that problem. Government, the way our government works, like I attempted to run for Congress, and the campaigning is all-consuming. But once Congress is every 2 years. They have to raise money. I mean, it costs, $1 million, $2 million to run for Congress. They have to spend all their time talking with rich donors to fund their campaigns. They don't have any time to think about any new policy. They're just thinking about, what luncheon do I have to attend to get money from this fundraiser? So, they're just not, they're not going to come up with the ideas. They don't have time. It's too much of a job to just keep your seat. But there just has to be a reset of the taxes. I don't argue with, businesses are going to lobby the Congress and try to get things put in. But at some point, I guess it's a president like a Reagan, like a JFK, they're the ones that have got to come in with the idea. They got to campaign all across the country. They got to get a consensus for what the people want that will align our tax policy to do the right thing. We have a lot of disincentives. The earned income credit is an example. The IRS says that 25% of the refunds that go out are fraudulent, and they know it.
What do you mean by that?
The earned income credit, it's kind of like it's replaced welfare in that you get, if you're a single mother and you have up to 3 children, you can get 45, whatever your wages are, and you max out at when wages are about $13,000, $14,000, you can get 45% of that back on your taxes. So they get a big refund. I have a client that I've been doing since 1991. She doesn't make much money. She always qualifies for the earned income credit. But I'll tell you a story. There was, she works in retail, and there was one new manager at her store that took her under her wing, wanted to get her into management because she's bilingual. It's in an area where there's a lot of Spanish speaking, and so he wanted to put her on the management track. But her refund went from being like $8,000 because she worked more money, so for 1 year she made more money, and the refund went to like $3,000. So that was the last time she wasn't going to make that mistake again. It's
the mistake of what? Of
the
getting
mistake
into management track? Or?
Making too much money and not getting this big.
So I'm just curious, what did she do? She went back to her earlier position, or what?
Yeah, she went back. She apparently does things to work her schedule around certain TV shows that she likes to watch during the day. So
okay, I got you.
And the people that are in this situation, they know where the earned income credit, they know where it maxes out.
Oh, I mean, basically they just play the cards well. Is that what you're saying?
Right.
So they can have it, not a matter of, for example, missing a management opportunity so that they can get 8,000 as opposed to 3,000.
Yeah. Okay. And it's short-sighted, but it's such, in the short term, it's such a big economic difference. When you think about it, she's got to work more hours to make that money. She's got to go to training for that. It's definitely harder in the short term. It would have worked out better for her in the long run, but it's hard to see when you've got to take such a big sacrifice up front. Most people don't do it. They get trapped by that easy money, and they don't see that to get the real money, the real reward down the end, they have to give that up so that they can get it. So there's a lot of disincentives in there.
I want to ask you a question. You mentioned the multinational, the big corporation, which goes down from 35 to 20,
25 to start and even go down further.
How does that affect small businesses?
Well, it affects consumers.
Do the small business taxes goes down the same way, or I'm just curious?
We have a concept in the United States of an S corp, so we have a separate C corps is more of an international concept. So the big multinationals are all C corps. Most of the European, Japanese companies are of that, where it's a separate legal entity, pays its own separate tax rate. Most small businesses in this country are taxed as a flow-through entity. Most small businesses are an S corp, so they don't pay it at the corporate level. They pay it at the individual level. So my provision for that wouldn't necessarily help small businesses per se, but having capital back here would help, and it would lower the price of everything. Anytime you tax something, you make it more expensive. The corporations will always pass on a tax to the consumer if they can. So lowering the tax would make things cheaper in most cases for the consumer.
So that's what you have, okay, lower the tax and money comes in, and then we can have some other incentives so that we keep going that until you reach a level where it's all the same worldwide, and that will balance it.
Yeah.
Examples you have, the Kennedy example to lower the taxes in the 60s, as well as Ronald Reagan idea of lowering the taxes.
Yeah. And Ronald Reagan in 1984, the GDP in the United States went up 7.3%, which was higher than any in the Kennedy years. I think Eisenhower might have had 1 year, 1959, I think, was maybe equal to that. But, if we could, our economy is growing at about a 2% rate. And it's because there's a lot of disincentives. There's a lot of disincentives in the code. I mean, if we could get that economy growing at 5% instead of 2%. Are you familiar with the rule of 72?
In finances, investment.
In finance, if you divide a rate of return into 72, it takes that long for an investment to double. So if you look at our economy, look at GDP as a rate of growth. So at 2% per year, we'll double our economy in 36 years. Well, if we could get that, under Kennedy, it grew 6% 3 years in a row, more than 6% 3 years in a row. And I think
24 years.
Yeah, so much
faster.
So if our economy is about 24 trillion, would you like it to be 48 trillion in 36 years or 24 years? And if you're growing the economy, that big pot bigger, I mean, we have an $18 trillion deficit that they talk about. We have a $100 trillion deficit. If the U.S. economy was on the accrual basis, meaning like businesses that are on the accrual basis have to use actuaries to determine what their pension liability is. If you're age 55, you're not receiving the pension yet, but when you're 65, you will. So they've got to factor how much it's going to cost them to fund your pension from age 65 to your life expectancy. So businesses have to put in a factor for that. The federal government doesn't factor that in. So that when they talk about an $18 trillion national debt, that's cash basis. But if you were to factor in the liability for someone who's 60, who hasn't gone on Social Security, and let's say if they live to 87 and how much, you know, they didn't pay in enough for what their expected payout is, when you add that in, it's another 100 trillion or more on top of the 18 trillion.
Very good.
So.
Okay, that's good. And I just want to let our audience know about the breakfast event over here, which you mentioned that you love, you like, and you like to invite them on the prior show. I just want to let you know that this is taking place at the Best Western of Fairfax, 3535 Chenbridge Road here in Fairfax. And it's once a month on Thursday. You can see the exact precise date on our website, which is blnbc.com. I also want to inform you about our expo coming up on May 22nd at the Stacy Sherwood Community Center. 100 exhibitors, 200 to 300 attendees. You should know that we still have sponsorship and exhibitors available. So join us. The website for that one is ultbizexpo.com. ultbizexpo.com. Gerald, I want to thank you very much for joining us today.
My pleasure.
And doing 2 shows and spending that much time with us. And I appreciate getting all this information because I want people to know that there is a possibility there to lower taxes. It has been done before for present for different kinds of camps, so it can definitely be done. We do need that so as to really expand and grow the economy.
Right.
I thank you very much for coming.
I thank you. Besile, can I say one thing that I had created a plan, and that's Strive for America.
Okay,
Strategic
check that
tax
out,
reform.
Strive for America. Thank you very much. Looking forward to see you next time. Bye-bye.
This program was brought to you by Organo Gold. Organo Gold is a health and wellness company that provides healthy coffees, teas, and chocolate. All one has to do is consume the available coffee, teas, chocolate, and other products to get all the available benefits. One can also share these products with others to help them improve their health as well.